grinding into Vega neutral as bulls attempt to outrun the short positions, the short put positions that the is long. There's a few instances of this happening previously as well. However, if Vega neutral is lost and the MM's long puts start to go in the money, you can get a big collapse like we did on the last test of VN back here. I think this one too, right? Those are both VN tests, if I remember correctly. Or maybe it was just this one. What date is that? Oh, wait, hold on. That was this one. This VN test. Not this one. This wasn't VN. I'm on the 15-minute, not the hourly. So yeah, those can slip back in the money, and this high can fail, especially if bulls start to take profits in this range. We're right up against the JPM collar, which doesn't expire for a little while, so there's no reason to think that we won't see some downside this week. It's just a question of, I think, how much, and we'll probably find out at some point whether the 6,000 level is supportive. There's not going to be much room above the collar, and even if we do break above the collar, it'll be hard to hold above it on the intraday. Generally, tests of the collar lead to more extreme sell-offs, and we haven't tested it yet. We came very close today, but not quite a test of it yet. I did expect this, and then Jolt's data obviously tomorrow could kind of upset things. I think if we see yields rise dramatically or the yield curve re-uninvert, then it's possible that we get a like a more mechanical failure, like a bit of risk off in equities. We are starting to see BTC risk off, which is generally a leading indicator that there's some profit taking going on. It usually goes up with equivalent risk on in equities and risk off in bonds. And so, yeah, we'll see. I mean, it's possible that we stay up here and chop a little while longer, especially with the bigger data prints into the back half of the week. But I think jolts might be relevant enough to throw a wrench in the current positioning. And also the support under spot is getting a bit weaker. There's really not a lot of support over the next few days below like 60-40. So failures of 60-40 have the potential to fall pretty far. There's also some synthetic shorts at 6,000 and 59.50 to the downside. And they're not huge positions, but they're not exactly tiny either. Dollar up today, which is a bit of a change. Still down against the euro, the pound, and the yen. However, it did rise very sharply against the yuan, so a little bit of momentum coming from there. But there is still some concern surrounding the carry trade. Now, Nakamura, the other kind of important BOJ president, is going to be speaking this week, and he tends to be quite a bit more dovish than Yuta. And since the carry has been reacting to Yuta's last statements, we've seen quite a lot of leverage risked off. Nakamura could kind of turn that around and may change some of the expectations going into the BOJ December meeting, where the market is currently assuming, I think, a 65% chance of a 25-point rate increase. Now, I think that might be excessive. I think maybe there's a higher chance of a 0.15 increase. There's still no political party quorum in the Japanese parliament, and making a big change to monetary policy without any dominant political power might be something that the BOJ doesn't want to do. And so I could see a case where there's a smaller hike. But remember, the last hike was quite small, and it led to a flash crash in the Nikkei. So, and leverage is about as high now as it was then. And so, I mean, yeah, that risk is still persistent. Commodities falling today. Obviously, some bad news out of China, rising dollar. Precious metals, it looks like. A little bit of a bump in oil, but still trading well below 70 a barrel. Got correlation kind of divergent with the 3-month, actually moving a little higher here, and the 1 month moving down a little faster. So we're getting a bit of a pullback in 3 month dispersion. So people are seeing risk on the horizon 90 days out, but still compounding risk in like the 30-day window, and still bullish in the short term, just not as bullish in the long term. Let's see. Yeah, carry leverage is about 787 now, down from 8.5x a week ago, so down to 7.8x today. A little bit of a bounce. It held above last night's or the prior day's close, but we are seeing some pretty rapid risk off. And remember, a lot of this leverage is deployed in equities, and so if we're seeing leverage decline here, we're likely to see bullish equity positions, and the long vol in equities and the dispersion trade fall off. So this could be a big sign that we've got like a correction coming in, especially if it continues to risk off. Bond volatility staying really low. Skew still moving up, but remember, the more skew moves up, the greater the chance of a like 2-3 standard deviation move in the opposite direction, because there's not enough tail risk hedges, and so the odds of a tail event happening increase as skew rises. 82.70% of the S&P above its 20-day moving average. That's really kind of staying right where we expected it to, right? So even with NQ and ES up day over day, we're not really seeing the entirety of breadth pick up. It's more that we're kind of seeing money move around and reposition, but nobody's really pushing the majority of the index higher at this point, like the rest of the majority of the index higher. We are still continuing to see vol shorting, and correlation between cash VIX and VIX futures is continuing to break down. Now, some of this is that moving into expiration, but that's not all of it, right? Like, that's not all just people playing like shorting vol into the VX expiration. A lot of this is just a ton of short vol compounded very, very close to the money, in an effort to drive indexes higher. Fed fund futures now pricing in 0.29 rate cuts after today, so almost no chance of a cut in December, and they're now pricing out the potential for what was almost 2%, so 8 cuts is now almost 1. And as the yield curve becomes reinverted more and more, the likelihood of the Fed cutting is going to continue to reduce, or at least as far as Fed fund futures see it. What would be very scary is if the Fed had to hike rates at some point. However, the yield curve is still positive at the end of today, but only by 1% between the 10 and 2 year. So on the technical side, yeah, we pushed a little higher today, but not much. This kind of looks exhausted. I would say that a pullback to like the 960 level would be moderate, like back to trend. And if support were to be found here, that could be bullish for another move up. But if that were to break down, we'd be looking at that EMA 30 and MA 50 test in here. Generally, if that fails, you get a steeper like 3 to 5% correction. So yeah, this is looking a little weak. Like, it doesn't have much room to go up. So I would say at least a small pullback into support in the short term, and then I would look for a bigger pullback should that fail. Anyway, that's it for now. I will see you guys tomorrow morning. I hope everybody has a great night. The 1929 trend is like right there. What is that? Like 60, 64? Yeah, no problem. Thanks, guys. I'll catch you later. Peace.